Steady performance from Minda, 20 odd percent growth in revenue, slightly better on the EBITDA and the bottom line front. Margins almost maintained relative to Bloomberg estimates, maybe about 80-90 basis points lower, but largely in line with what they did, 10.67 versus 10.41 in the corresponding quarter last year. Let's get in Sunil Bohra, who is Group CFO and CEO of Minda, to talk about how he thought the quarter went by and what does this mean for the rest of the year. Sunil, good having you. Thanks so much for joining in. Satisfied with the performance? It seems to be a steady state quarter one.
Absolutely, we are very, very satisfied. And specifically when you see in the context of the industry volumes versus our growth, while we always say that our target for medium to long term is not a growth on a quarter to quarter, but on a sustainable growth of at least 1.5x to what industry grows. And if you see last quarter in the industry, our volumes actually have grown just by 2%. And our revenues, we have grown by 21%. So I think there is a significant improvement. And to answer to a point, I think there are a lot of positive tailwinds also in the way of premiumization, in way of the EV transition, the way we have built up our EV portfolio. We do expect this growth momentum to sustain for medium term to long term.
Sunil, there are multiple points which I thought I read in your results as detailed by our research team. Incremental orders from global customers, you're expanding capacities in a big way or a new plant across multiple line items as well. Tell us a bit about what went right in the quarter and how will it move ahead in the quarters to come?
Yeah, so you are right, Neeraj. We are currently having 10 projects which are currently ongoing, be it a greenfield expansion or a brownfield expansion. And across products, you see lighting, you see switches, you see alloy wheel two-wheeler, you see alloy wheel four-wheeler. So across the board, and specifically 2 new plants for the EV joint ventures with Frevo and Buller. So I think we have seen a significant positive from all the angles. So if you go by business, right? So you see alloy wheel, that is led by the premiumization wave. The sheer penetration or application factor today in India is something like around 40-45%, which when we started a few years back, it was 15%. Globally, the application is almost like 90-95% kind of range. So we do expect that momentum to continue for about 5 to 7 years at least going forward, which is basically with the increasing application factor, the production or the requirement of alloy wheel grows more than what industry grows. That's number one. Number two, the alloy wheel two-wheeler is primarily an import substitution strategy or the wave which we have been riding on. Then you see lighting. It is primarily the premiumization wave from halogen lamp to LED lamp. We have just commissioned our 4 lighting plant in Gujarat. We have procured a land in Pune and we are in the process of starting the work there. So then you move to switch. We are having 2 plants which currently going on for construction in Chennai and Faruk Nagar. Then there is a lighting plant in Vietnam, just getting commissioned. So I think across the board, you see there are various levers. We have been gaining share of business also. So there are a lot of angle which we have been working on. And fortunately, I think there is a tick in the box in sort of every strategy.
In which case, talking about average capacity utilizations might be a bit of a misnomer because you have plants coming on stream virtually every second quarter and therefore add to the revenues. So capacity utilization levels, do you look at them at all currently?
No, we do look at, absolutely we do look at. In fact, some of the plants are running close to 100%, and that's why you need that capacity, because there is also a requirement from our customers, which is the right requirement, that whatever is the capacity, you need to have at least 20% of a buffer for any positive up move. So while, yes, I do appreciate that there are new plants which are coming and we'll have almost like every quarter one plant getting commissioned, but even the existing plants, we are trying to debottleneck and create that capacities so that the customer line requirements are met and there is no scarcity of capacity.
So this string of pearls thing of sorts of capacity expansion, as things stand, for how long does this last? I mean, do you envisage a plant or a debottlenecked capacity coming on stream for you every second quarter for the next 2-3 years?
No, absolutely, Neeraj. In fact, we are even thinking beyond that. So we have just bought a patch of 86 acres of land in Pune. And this is primarily for future growth. And if you see from a business perspective, normally the plant sizes will range from somewhere from 5 acres to 20 acres, right?
Yeah.
20 acres high capex alloy wheel plants, whereas some small plant will be 5 to 8 acres. So if you see that in that perspective, 86 acre for our business is a huge block. We are looking for another similar or even larger block of land in north and a little bit smaller size in south. So we are working on our next 6 to 7 years long-term strategy plan, and we do expect the requirement for land actually to continue not only 2 3 years but also much beyond it. So we are quite bullish, and for next 5 to 7 years, there is enough growth which is there.
And would most of this capex being done by internal accruals, or do you envisage at some point of time, because of this large expansion, I mean 86 in Pune, if you get a large parcel of land in north as well, then do you need to raise any equity capital for any of these capex plans?
Not at this stage, Neeraj, because if you see, I think the business has been able to generate healthy free cash flows. So this year, say for example, if our EBITDA is even conservatively at 1,400 crores, something like that, the capex is just like 700 crores, and if you put a land bank, we are, I think, sufficiently funded from internal accruals. Yes, there might be temporarily mismatches in terms of cash flows, which we do expect to sort of meet through the short-term borrowings or based on the cash flow, short to medium-term borrowings.
Okay. Sunil, excuse me for not knowing this, but have you given a formal guidance for FY24 or FY25 or a 3-year plan? And does this Q1 performance keep you firmly in track for achieving or beating that?
Yeah, so Neeraj, normally we don't give a guidance for top line, because you know that our destiny, 90% of revenue is linked with the OEM revenue. So there is no point in me giving numbers. And that's why we say whatever industry grows, we will grow at least 1.5x to medium to long term. And that's the outperformance we want to target. Because if we start giving a number and there is no OEM, or there's a dip in the volumes, you can't manufacture and keep it in your inventory, right? So from that perspective, we normally avoid giving any revenue guidance. But if you ask from the expectations and our internal plans, I think we are well on track. And if you see last few quarters, I think we have actually done better than even some of the internal expectations.
Which is good to know. One final question, and which is how relative to what you are, or relative to what you were in the EV versus the non-EV portfolio at the end of FY23, is there an internal target, say 3 years out, that you will be X percentage EV versus non-EV? And part 2 of my question, does that kind of a portfolio mix also help in the ECG profile and thereby the multiple profile that a company like yours in a business like yours would get?
No, absolutely. So first, to start with, our existing business, you will appreciate, they have sort of agnostic to IC or EV. So you talk of light, wheel, switches, lamps, on. All these products, you will find application in IC engine as well and EV as well. So EV, we have more been looking as a potential for a significant delta to growth. And I think we have been one of the early movers. We have sort of laid down our EV strategy for two-wheeler and three-wheeler segment almost like 4 years back. The kind of product profile we have built in, I think that is unmatched to the industry. In terms of revenue growth, you would have seen that the last quarter, our EV revenues is almost like 12% versus the 4% share of EV in the two-wheeler segment per se. And in terms of order book, we already have an annual revenue of more than 200 crores of orders already booked from the EV-specific vehicles, which will include existing and the EV products also. And that order book continues to build in. So in terms of revenue target, it's little tricky to give, and I'll tell you why, Neeraj, because ICE engine market has developed for more than a century. So there are clear practices which are settled, what will be outsourced, what will not be outsourced. But if you see from EV perspective, A, there are a lot of imports. B, even the industry is trying to figure out what one would try to manufacture in-house versus what you would try to outsource to people like us. So, for example, there is a EV component which we are supplying to one customer, but another customer is doing in-house. So the market also is evolving. So it will be very tricky to sort of put a number on the table that this is the target revenue target you have. But based on whatever guidance we have from our customers, based on the secured businesses, today we have almost, as I said, 2,600 crore kind of a revenue, annual revenue for FY26, and the book is consistently sort of building up.
Got it. Okay. Completely understand. Just one. Okay. I'll extend this interview by one more question, if you allow me, Sunil.
Please.
And that is, I don't want to ask you about whether EV will grow faster than ICE, because both are equal customers for you, both are important customers for you. What I do want to understand from you is that the industry is going through a metamorphosis like no other segment of auto, at least in India, because in India, the EV adoption of two-wheelers is a lot quicker than what's happening to four-wheelers. So would you say that because your products are agnostic to ICE versus EV, you don't get impacted too much, even if at a future point of time, the EV growth will slow down and ICE engines continue to prevail? That may not happen. I'm just trying to understand, if that were to happen, would you still believe that your portfolio and growth will remain unaffected because you are agnostic to EV or ICE?
Absolutely. So for all our existing products, it remains unaffected.
And therefore, you, correct me if I'm wrong, but if you have such a large share of two-wheelers in your portfolio, that doesn't matter because you are agnostic to EV or ICE.
No, absolutely. So if you see the overall pie, I think it's important to understand from the total revenue perspective, my two-wheeler revenue is roughly around 40 to 44%, right?
Yeah.
Of that 40 to 44%, as of now, 12% revenue is from EV. Now, when I say 12% revenue, it is not only EV component, it's EV vehicle. Now, roughly maybe half EV specific components and half is my existing vehicles. So if you see from the overall impact perspective, yes, there will be some impact, because once the weightage from EV shift back to IC engine, which may or may not happen, as you rightly mentioned, because of that, the EV specific components which we have built obviously will not have application, right? So to that extent, yes, you will see some impact, but we don't expect that impact to be very significant.
Got it. Yeah, but that may not even happen. I mean, just looking at the scheme of things, if anything, that's an irreversible trend. But Sunil, this is good talking to you today. Thank you for that clarification. Congratulations on a good start to FY24, and all the best for many such quarters ahead.
Thank you. Thank you very much.
Namaste. And viewers, thanks for tuning into this conversation with the management of Minda.